Well, hello everyone. Welcome to Money Matters with Hill Financial Group. I'm going solo on this one. I'm Casey Harding, and today we're going to tackle when to take risk and when to maybe play it safe. And so, just understanding risk tolerances, especially at different ages and different stages of your investment life. And so, we'll walk through all that together. Before we kind of jump into some of those topics and looking at the different risk timeframes, let's call it that, we're just going to talk about what is risk tolerance, not just the emotional side, but also the financial capacity. So, how much am I willing to risk? How much financial, like numbers wise, how much am I willing to lose or see the account go down to until I feel that pain and it feels uncomfortable? And so the risk tolerance is a factor of comfort level, but it also your capacity, your kind of what you're willing to kind of like I said, that pain threshold of where it's like, oh, that I'm uncomfortable. So we've had these past experiences. Most recently with COVID, and then prior to that, we had 2008. If you were in the market, back in the early 2000s in the dot-com bubble, these were different, really pain points that I think where we felt the most, the general public felt the most pain, or there was the most talk about those periods of time. When we look at, back in the 2000 time period, that was, probably that was the only period in the market's history where we've had 3 years in a row where there was negative performance in the overall market. So that was, 2000 dot-com bubble, 2001, 9/11. And then 2002 was just kind of the recovery and trying to get out of that. But that was the only 3 year consecutive period of time where the market was negative all 3 years. Then in 2008, that was super painful because we saw a 50% pullback in the overall market. However, we were back to par, or back to kind of where the market was within an 18-month period. And a lot of people don't remember that. They just remember mom, dad, or grandparents, they pulled out and then they lost all that money because they never got back in the market. You don't lose unless you get out. And so you sometimes have to ride that roller coaster, as painful as it might be. But the significant piece there is we had recovered, and market was back to where it was prior to that '08 recession period, only 18 months later. And so if we could have just held tight and not pulled out, you would have been just fine. And but I know that was a painful period when a lot of people just jumped out and they never got back in, and so they did see a significant drop in their overall wealth because of that. And then COVID, it was a huge dip really fast, but then we recovered really fast, and that has a lot to do with what the government did, and pumping a lot of money. And then we had an inflationary period, and we're kind of where we are now. So those are just kind of when you think back, and maybe this is kind of bringing back some memories for some of our audience. But yeah, so then how do we navigate that? And so especially when we're talking with our they're just getting started, or 25, 30, maybe 40 years in age range, how risky should I be? And my general rule of thumb there, just based on age, would be you should be 80 to 90 or 100% in the market. And we're this is when we say in the market, this is stock market, equities. You should be your portfolio should be somewhere in that 80 to 100% in the market. If you're in your early or late 20s, early 30s, 40, that's your growth period. And so that's a general rule of thumb, but every investor is unique. And so we're having that conversation with you. We're trying to get an idea of, what is your pain points there for how much you're willing to lose. And so we can say, all right, if you got 100,000 and you saw that, drop to 80,000, oh, if that's over a 2-3 year period, how's that going to make you feel? Are you going to be nervous and want to pull all the way out of the market, or is that going to be okay and comfortable for you? So we have tools and ways to ask questions to assess that, and then we're going to allocate you appropriately. But general rule of thumb would be, especially if it's in retirement accounts, these are IRAs, 401ks, Roth IRAs. That's money that you're not supposed to touch until at least 59 and a half, 60. Most people aren't going to touch it till 65 plus, and so that is money we should be able to invest. Go in. Don't take it out. Don't shift your allocation. You should just be in the market, let it do its thing, and not worry about it. And so that's kind of where we would be at in that 30. That's your growth. We'll push the accelerator down, and we're going to get as much as we can while we're young, and ride that roller coaster. While it might be a little bumpy, but if we hang tight, we're going to see the success on the back end of that. But so then we get into kind of this age, 40 to 55. What do we do there? Well, if we go back to what I referenced earlier, and we're thinking like, okay, the worst period, 3-year period, was 2000, 2001, 2002. All the other pullbacks that we've experienced in the market, we've recovered from, within at least 18 months, to 24-month period. Why are we not staying fairly aggressive even as we get, closer? If I'm 10 years out from retirement, that means that like there's a good chance that we're going to see the market, averaging around 8-9% as it has historically, since its beginning. And so if we know the market's going to recover within a bare, minimum 3-year, 5, I say 3 years, it's the only time it's happened. Let's say 5, then why are we pulling out? Why are we getting less aggressive? But again, I know as we get older, we trend to be more conservative over time. And so we're going to maybe allocation wise, we're maybe, at the beginning of that 40 to 55, maybe we're at 60-40, maybe we're at 70-30 from an equity to bond ratio in your portfolio. That's kind of general rule of thumb there. But I encourage my clients to, if you're still 10 to 15 years from retirement, let's continue to be aggressive. We're going to reap the rewards, of that, aggression, and trying to get that return, averaging around, 8-9%. None of that's guaranteed. Put that disclaimer in there, but we're just looking at market trends and what the market's typically done historically. So, but again, we're going to assess that. We're going to ask you those questions and go, and then we're also going to, bucket out your money. So how soon do you need this? If this is retirement and we still have 10 to 15 years, we're gonna keep that allocated in a more growth path for you until we get to that 5 years out from retirement. That's when we're going to start having that conversation of going, how much of this wealth, how much of these assets are we going to need within the next 5 to 7 years? That's at that point, we're 55, 65, we're in that 60 age range. We're going to go, when do you want to retire? How soon's that coming? And then we're going to reallocate you appropriately, and we're probably going to what we would call bucketing your assets. So if it's we're going to need 100 to maybe 300,000 of this over the next say 10 years. Then we're going to be a little bit more, conservative with that money. It's called the income bucket. And then the rest of the allocation, the rest of the assets, whether that's $500, $700, $1 million, that will stay more in the growth, because again, we're not going to touch that money for 7 to 10 years from now. So we can allow the market to continue to accumulate and grow that bucket while we're spending out of that income bucket. And so that's the way we like to, allocate our clients and kind of subdivide your assets to where we're looking at really keeping that income stream coming from a lower volatile, a much more conservative allocation for you, and then you're not as concerned when those dips in the market are, because we're pulling from an account that's not having those extremes of the ups and the downs. So that's kind of the how we reduce your risk there, and really provide that stability for you, and helping you understand, like, where you're not scared, because we've taken good care of how we have you allocated, and you feel that security, because the income bucket's not jumping up and down. But it is a psychology thing, and figuring out, like, what your pain threshold is. And so if we say, you've got $1 million, million plus in assets, and you see that go down to 900, 800,000 in a given year, that might be a pain point for you. But that's why we're going to diversify that out. We're going to give you a growth bucket to where, if that growth bucket goes down, 30,000, 50,000, 100,000. Again, we're not taking money from that, and so we're not capturing that loss. We're not locking in that loss, because we're not taking money out of that bucket. And the other, 300, 400,000 that we have in your income bucket, maybe it goes down 10 or 15,000 in a given period of time, but because we're only taking out a monthly amount to offset from security or Social Security on that money, then we're not feeling that pain as much, because it's not these huge swings in the overall balance. And so that's kind of how we take care of that psychology, is we're really keeping you informed of how we're allocating in those different buckets inside your portfolio. But we are always, we understand, that this is what you've worked so hard for. So we want that financial security to be there for you. And we're here to kind of help with those fears, especially when we hear, everything that's going on in the market, and, are we in a AI bubble? Are we in a, whatever, kind of the new hot, with the things that are going, in Ukraine and Israel, like what these are, global risks. But how are we allocating you appropriately and managing your portfolio there? The other things that to kind of wrap it up here, your risk tolerance questionnaire that we give you when you come in for the first couple of meetings, we're looking at that. We re-give that to you so that we make sure that we're staying in line. And so we're constantly assessing your risk as you are a client, so that we're never getting too far ahead of you from being aggressive versus being conservative or balanced. Whatever, we're having those conversations every 6 months, because we're wanting to see you, and you're having you come in, to have those conversations. So we kind of keep a pulse of what's going on in the market, but we also try to keep a pulse of you by constantly communicating with you when you're a client. And so these are the ways that we manage risk, and what we look at when we're trying to see, what stage of your career are you in? Are we in the growth phase? Are we kind of in the middle phase of your career, or are we're 5 years out from retirement, and we need to have that conversation of moving some money off the table and putting it a little bit more conservative, so that we don't want to have a big drop right before you retire. So these are the ways that we manage risk, and how we keep a conversation going and this is how we think about it here at Phil Financial. And this was Money Matters. Money Matters.